Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Charlotte Vincent, co-head of fixed income at People's Pension, to the show. Welcome, Charlotte.
Thank you, Charlotte. Thank you for having me.
Yes, it's doppelganger central here today. Not only we're both called Charlotte, we've both got co in our business title. It's all a bit creepy. But do tell us, what is your news story of the week?
So my news story of the week was Iran war inflation shock set to fall short of the 2022 surge.
Now, it seems it's kind of odd asking somebody at fixed income, why was a story about inflation of interest to you? But do tell us, why is the story about inflation of interest to you, Charlotte?
Well, it boils down to the key reason I do my job and why they pay me, hopefully, is that all I'm basically here to do is produce good member outcomes. We want to provide a solid retirement income for those in the future. And to do that, we have to get all our members real returns. So it's not just returns, it has to take into account the inflation. So if we'd earned 10% and inflation was 10%, wouldn't be a great result for our members there. So real returns basically is what's going to give our members their best outcome. So that's why we really care about inflation.
And fixed income is obviously only part of that portfolio, but that's your domain. And there's obviously other bits of the portfolio invested in other assets, which also hopefully produce real returns, such as equities and private markets and all the rest of it. So it's all part of the mix, isn't it?
Yes, no, it's luckily it's not all down to just one side. That hopefully you have all engines firing, but sometimes some are going up and some are going down, and you're hoping that what the outcome of that is that you've produced a good overall real return across the whole portfolio.
And I think it's fair to say that People's Pension has a different approach to investing in fixed income to other master trusts. And that really came about when you assigned Invesco as your fixed income manager back in February last year, I think it was. And you've got a lot of dynamic elements to that portfolio. So talk to us about how you approach fixed income at People's Pension.
So basically what we want to do is, again, going back to those member outcomes, we need to make these real returns, but obviously the world changes, the world isn't static. So what we have to produce is a toolkit that we can basically be dynamic and flex different ways according to what we require at the time. So what we built into that portfolio was some key attributes, which meant that we have some regional aspects, so we can decide to be focusing on Europe or focusing on the US or focusing on the UK or focusing on emerging market debt. That we also have a quality scenario that we can be at the top with the AAAs, or we could be all the way down to the single Bs if we're looking at more high yieldy aspects. We also have given ourselves the lever of whether we want to be active or passive. So actually we tend to be more passive on the higher rated, very liquid markets like government bonds, whereas we're absolutely fully active as you go down that quality spectrum, or if you go into more complex instruments. We also, we have a duration bias. Do we want to go at the short end of the curve, the mid end of the curve, the long end of the curve? Where do we feel the best value can be found? And what that really just does is it enables us to create those member outcomes for different members at different stages in their journey. So if you're a growth member, you've got a very long time horizon. Therefore, you're going to be looking for, you're less worried about drawdowns because you can recover from those, and you're looking for some growth assets. Whereas if you're about to retire in 3 years, the last thing you want is to have a big drawdown, which would do that. So you have to use different tools and, basically think, right, how do we solve the right answer for the right member, and taking into account what they require.
Mm-hmm. Okay. And that wasn't enough that you had this dynamic fixed income portfolio. Then about sort of 6 months later, in October last year, you also invested 250 million in collateralized loan obligations, also with Invesco. Talk to us about your thinking behind that.
So for those who know CLOs, we invested it. That was our first investment in CLO. We were the first DC master trust to do so. And what we were doing was investing at that top level, that AAA level. And CLOs sort of are one of the most fantastic instruments, especially for pensions, because what they have is especially at that AAA top, they've got over a 20-year zero default. So, this has been tested through COVID, through the GFC. Like this is a very, very strong, highly rated. So it's giving me high quality assets. What it's also giving me is quite a lot of diversification, because when like us, you're investing in CLOs. I'm not just investing in whilst Invesco are running the fund, I'm investing across 40, 50 different managers. So I've got some manager diversity. I've also got vintage diversity. So I'm not just investing on the deals that were made last week, last month. I'm investing in some deals which were made 5 years ago. So I've got a nice range of diversity there. Finally, the best thing, it's got the industry diversification. So the thing that scares a lot of people is when you have those industry concentrations. Whereas actually in the CLO market, they have a diversity score. You have to be diverse. They test this on a monthly basis. So you can't ever get these massive concentrations built up of we're just going to do 50% in healthcare because that's what we fancy to do. No. It's very, very, very diverse. And you get beautiful pie charts when you sort of see all the different industries, because there's lots of different things. But the other aspect of CLOs is that they have this huge structural protection. So when they were created originally, sort of in the late sort of 90s, early 2000s, they made them very secure then. And after post GFC, even though they survived GFC and did very well, the people went back and went, actually, we can do more here. So actually, we've got so much subordination below us. We've got about between 35 and 40% of an equity cushion, which does give you, obviously, which is why you've got that zero default rate, because it would have to eat through a lot to get there. And they've really tested that. And I think there was a great study that they tried to assume if it's sort of the default rates went up to 20% for 5 years in a row, and it still wouldn't hit the AAAs. And obviously, if we've got 20% 5 years in a row, we've also got a lot more problems than that. But yes, and finally, it's that complexity premium that because they aren't so well understood, that actually compared to all the other instruments, the AAA instruments, they pay quite a bit more. So they're actually providing a really good risk-adjusted return to us. And I keep on saying, it sounds like so many things, but they're floating rate. And what that really adds to us is it takes away this interest rate sensitivity that fixed income has. And it means that, obviously it's still, there's always risks. There's, you can no such thing as a free lunch, so to speak. So, but we're shifting that to the credit risk. And yes, that floating rate means we're adding in a part of the portfolio which isn't going to be so affected by interest rate movements as the rest of the more fixed income part.
Mm-hmm. Yeah. And that floating rate, I mean, given that the original article we talked about is basically Goldman saying that they don't think the inflation shock because of everything that's going on the Straits of Hormuz is going to be as profound as initially thought. And we've been through, over the last 12 months, we've been through so many different scenario, ideas the market has had about where interest rates are going to go. It's just been, it's been a bit mad.
It's been a bit mad, but actually at the same time, especially for the CLO AAAs, it was actually a really good proof of concept. When you've had these market volatilities, because they're not the market volatility, since this started at the end of February, it's been mainly in rates. It's not sort of like credit spreads haven't widened dramatically, but the rates effects obviously have caused issues. And so whilst you might have seen the gilts trading down, even the IG trading down, it's not trading down because they think they're going to default. It's trading down because of the rates risk attached to it with the duration. Whereas CLO AAAs just keep on chugging, keep on going. At one stage, that's not the case now because obviously we've seen some recovery. But for most of March, it was our best performer in the whole portfolio. And that's not why we didn't buy it to be the highest yielding, but it's just because of that rate volatility and that protection from that actually meant that those CLO AAAs did exactly what they were supposed to do.
Okay. So we mentioned that you've got all this dynamic elements in your portfolio and that you can shift everything around duration and regions and sovereign and et cetera, et cetera. Every which way that you could cut fixed income, you seem to be able to move along a line about where you want to be. So I think you've just gone through your annual fixed income review. Give us a bit more meat on the bones on, you've got all these options. What have you actually chosen to do with it, and how have you chosen to change it?
Well, so the first thing is back to that member outcome is that we have we have one very large default fund, which is for our growth outcome. And then we have our pre-retirement. So last year we separated those, and that actually has enabled us to, again, use that toolkit far more effectively to answer the correct questions for the correct groups there. Because as we said, that long time horizon for the growth fund, what we were doing there is, because previously they were a bit commingled, we were able to sort of look at that and think, actually, we do want this to be more growthy. We can actually increase the risk slightly here. So we increased our allocations to emerging market debt and to high yield there. We still retained our key anchor core portfolio as in the IG, because that is that sort of solid, secure bit there. But we actually were able to move the dial up there. Whereas actually in our pre-retirement portfolio, that has that short time horizon where we can't have those dips. We can't even in times of volatility, we don't want that to ever be hitting the returns massively. So what we were doing there is actually using those AAAs again. So we've diversified the risk there. So previously with the fixed income, obviously anything with duration has a rates risk. By adding in some more floating rate, we were basically diversifying our sources of risk there. But what we haven't done is we have a small allocation to high yield, but otherwise it's that IG and the AAA. So it's incredibly highly rated for that retirement portfolio to ensure that we aren't getting those dips. We aren't going to get those drawdowns, that we're just sort of really looking at income preservation, I suppose would be the correct word there.
So apart from sort of splitting out, and I mean, if you were to take that to your logical conclusion, you might decide to go for a target date fund approach instead.
Actually, no.
Because then you could, as people move through that journey, you would know exactly how far away they were. I mean, I know that Nest is the only person with target date funds, but I think.
Yes. I think we think that actually if we're looking at our retirement product, our pre-retirement product, so to speak, that's actually on a glide path. So when it becomes really important, when you do in effect have, you're thinking, am I 10 years away from retirement? Am I 8 years away from retirement? Whilst we have a pre-retirement fund on the fixed income side, the glide path is how much you're going into that versus the normal fund. So in effect, you're kind of using that glide path, you're kind of getting those target date returns, whilst at the same time still solving the big issues rather than trying to just micromanage and sort of little adjustments. Whereas we think, yes, our default fund, if we look at our default members, I'm going to get I think our average member is about 33. I might be wrong. Is it between 28 and 35? Hopefully that will cover a nice thing. But so yeah, we believe that for these people, actually, you're looking for the same thing. You're looking for that long time horizon. You can take on more risk. You're looking to get those returns that really mean that you're going to be able to build your pot up ready for when you sort of get to later on in your life.
So apart from sort of splitting the fund between the pre-retirement and the retirement, and you've talked about how you want to invest in different bits of the fixed income universe in each of those, which makes sense. Have you changed anything else on that dynamic glide? You've got all that dynamic ability. Have you changed your views on duration, for example, or changed your views on weightings between sovereign and corporate? Anything else apart from
Yes.
that split?
So we actually have, so our pre-retirement doesn't have any exposure to sovereign debt. And in our growth fund, we have been reducing our exposure to sovereign debt. That's partly because I think there's lots of questions, what does sovereign debt provide? And the main thing that, sovereign debt's fantastic for is liquidity. Mm-hmm. And the one thing that we aren't in massive need for is liquidity. So our need to have those sorts of, the treasury market is open all day, every day. Like, you can always access it. It's a fantastic market. But the fact of the matter is, when you are a 25-year-old, you're not accessing your pension for at least another 30 years. We don't need that liquidity in that growth phase. So what we sort of have to look at is then we go to that IG portion, which I said we can have those regional biases and we can have those duration biases. We actually have been more biased towards the short duration for quite a while, for the last couple of years at least. That's been done on purpose because we didn't really feel that we were being compensated enough to take out that duration, especially as, the curves at one stage obviously were very flat, which means that you weren't getting paid a massive amount of premium to extend if you extended your maturity. And yet, by extending your maturity, you did increase your risk quite dramatically, because the longer duration gives you that bigger swing with any rates movements, which obviously we've been seeing. And also because we do believe that we had beliefs in sort of whether the curve was going to steepen more at the long end as well as just coming down at the short end. So we really like the short duration for the investment grade portions. Regionally, we are a UK pension fund. We do have a bias to actually the UK on that one, but it's not a huge bias, I find, being honest. It's pretty evenly distributed, but there's a slight bias towards the UK. And then the emerging market debt and high yield markets actually are automatically quite a bit lower duration, so they don't add much in duration. There again, the focus there is on that really active structure, that really bottom up. We only put, but when I say we, our managers, would only buy something that they really know, really understand, and really believe is additive. So if you were in a passive index, let's say the passive high yield index might have 2,000 names. We're probably only going to be investing in about 300 of those names. So, but we're investing in the 300 names that we believe are the best 300 names. So we're just not going to invest across the board. We're very active and very selective.
You mentioned there that you don't have a lot of sovereign in any part of your portfolio because you don't need the liquidity. And I think that's a really interesting, it shines a sort of interesting light on something that we've touched upon in this podcast before, which is with a sovereign debt, as DB dies, die is probably an exaggeration because it's probably going to be with us for another time. Yes. Gently extinguishes is probably more accurate. As it's probably going to be with us the next 30 or 40 years. But if People's is indicative of what other DC schemes do over time, and you just don't see the need to have sovereign debt, and especially not gilt markets, which the UK gilt market has been so heavily reliant on pension schemes to sort of mop up all of their issuance. That's going to be really interesting. Is it going to be a long game to watch it unfold?
It is. And fun enough, and it was something that we could point to. There was another article that was in the FT over the weekend, which is always taken to it was from Alphaville. And I love Alphaville. And actually, they're very funny, they're very witty, but they did an article saying, what if we ran the debt management office? What would we do differently? And I think what they did is they really honed in on your point there, which is that those long dated gilts were brought up by those DB pension schemes for a long, long time. And in fact, the DB pension schemes kind of got in a doom. They had to buy them because, as they bought them, but then the yields went down, which meant their liabilities went. So they had to buy more and more and more. As that's gone away, the buyers for that long end aren't there really anymore. In fact, the people who are buying in the long end at the moment are more hedge funds. They're the ones who are taking, and hedge funds are definitely in there. They're not in there for the long term. They're taking positions because they believe they can benefit from that. And this article, it was really interesting because they pointed out something which I have to be honest, I hadn't noticed because it's not something we trade in, but they were basically pointing out that we don't really have that really short-term T-bill market, and that actually that's where, because that's the cheaper end of the debt, and that's they should be doing far more there. And I thought it was an amazing piece because, as I said, T-bills aren't going to be something we invest in personally because they're too short term, but actually the fact that everyone else is doing the T-bills and we're not does point to something that maybe Alphaville, even though it was reasonably very well researched but slightly tongue-in-cheek, actually probably have hit on quite a good solution to the fact that you don't have any buyers at the long end, but you've got lots of buyers who want to buy at the short end.
We don't issue any short-end note.
And we don't do that. It seems like a bit of a mismatch there, but again, I'm not.
It is a fun article, but it's written by Toby Nangle, who obviously everybody in the industry adores Toby Nangle, but it's a hilarious piece because I recognise it as a fellow's pensions geek, because it was basically, it's a bit of a Trojan horse article. It was basically, I'm going to unload everything you need to know about why the pension market is the way today. And it starts where I would start, which is, let me tell you about this geezer called Robert Maxwell and his, basically running off with the Daily Mirror pension fund. So,
he fell off the boat.
Yeah, and then before he fell off the boat and became the only Bob that didn't. But it's a very long article, which is basically, it's Toby's, I'm going to download my entire brain as to why we have the market we have today in one piece. So yeah, it is good fun. It's very illuminating and educational.
And actually, this one didn't have it so much because I think it was such a long article and so in depth. But usually with Alphaville, actually, it's the comments that, they often say don't read the comments because you actually slightly get sad about humanity. But actually, the Alphaville comments are always really, really good value and often really insightful. And they sort of bring out, so if you, with shorter articles, they often sort of come in with things. You're like, oh, yeah, that is quite good. And like, they make a correction saying, I think you mean this. You said places.
I didn't realise this either. Maybe this is something you have to consider for People's next year for your entertainment budget, that Alphaville has the geekiest sort of financial quiz ever in existence. That happens in May.
I look at it and I'm like, I think you have to be. I mean, I think it's often they have really good equity analysts. They literally have it every week as well, like 2 charts, and they literally just show you a chart with nothing there, and you just have to recognise. And the answer's like, oh, that's Nestle's free cash flow or something. And you're like, they have winners. So there were people out there who every week get, and they have, they don't give you anything. It's like literally, it could be a share price, it could be anything. But what it isn't is the things that you and I would go, oh, is that sterling?
I know. I did look at the quiz and go, I think I would get 1 out of 100, and I'm a financial geek. And it also, the question was really hilarious because it is basically, it would reward a financial journalist who like lives, breathes news every day, all day. It's basically, you could see that that's exactly what it's designed for. But I think Charlotte you've got a year to prepare and just read every news story, and you need to build a people's team for the FTL quiz.
Well, I think I will move to, if you go to the Unhedged podcast, they do one where they just drink, they just go to pubs, and their ones tend to be a bit more sort of, a bit less tough on the brain, a bit easier, a bit harder on the wallet maybe, but yes, they seem a bit more on the fun side without actually having to learn 8 million charts. So I might go over to Unhedged instead of the Alphaville.
But then again, you and I should do a team together because we could just call it the Charlottes, right?
Charlotte squared.
Yeah, exactly. I've got more squared because I've got, exactly.
Oh, of course. Well, yeah. I mean, a pun obviously did that on purpose.
Anyway, back to the sexy world of fixed income. We have took a great tangent there. Yeah. So over time, how do you see your whole fixed income portfolio developing further? Are there other areas that you want to invest in aside from CLOs, or is it about more granularity, or is it about maybe divvying up the fund? Is it about, I know retirement income is something that you're still thinking about and you haven't designed it, but that's obviously going to have a fixed income element to it as well.
Yes, I think there's definitely, funny enough, I think there's obviously some post-retirement work which is going on. I know that the government's still sort of coming out with things like that, and people are working very hard on that. Although I do think probably even when we do that from the fixed income side, most of our toolkit could probably be utilised. There might be 1 or 2 small gaps that they might want something a bit more niche. Certainly a bit more like the DBs, it's sort of not LDI, but sort of like those sorts of aspects. But the biggest actually thing that I think we need to focus on is more around that growth area. is that since that separation of the pre-retirement and the growth, that does really mean that we need to look at the fixed income growth and really work out, have we got enough growth in there? Are we doing enough? And the big caveat just has to be that member outcome, which is so important. We're not here to place bets, so we can only ever do something when we have fully researched it, and that is it's not a process of moments. So myself and my team are certainly going to be really looking into aspects of private credit. We're certainly looking at more growthy areas of MAC funds, areas that basically, so we talked about the CLO AAAs. Obviously, you can move down that spectrum. You can go into the MES portions. You could look at the CLO equity. But the fact of the matter is, as I said, these are not a work of moments. And sometimes you can do a lot of work and the answer still might be, actually, don't think it adds enough. Or is it, you're going to have some very key criteria everything's going to hit. But obviously, part of our role is that I'm going to constantly have to look to make sure, am I looking at everything? Is there anything I'm missing? Is there something that would really add a secret sauce, so to speak? But for now, it's just a lot of hard work and making sure that we have all the information to hand.
I mean, you mentioned private credit there. I mean, the flip side of your argument about we're not really interested in sovereign debt because we don't need liquidity. UK government is going to have to start issuing something that people actually want to buy. The flip side of that is everybody hearts global credit, basically. And you've got in another sort of aspect of UK pensions, you've got about 550 billion forecast to flow out of DB pension schemes and into insurers via buyout over the next decade. And insurers love global credit, and you guys love global credit too. And you've got all of your receipts coming through. You've got all of your contributions coming through every month. So I wonder if, as kind of like nobody wants to invest in sovereign, is everybody who's left in the pension market going to be chasing global credit? And we've discussed this before on the podcast with Tajid Singh about how there isn't really, the UK corporate bond market hasn't really grown for 10 years, and it really needs to grow. And is that something you're thinking about? Is there enough liquidity?
I do. It was Mario Draghi's paper, which I think is actually going to be really pivotal, is that Europe doesn't have a huge securitization market, and they've done the studies and they think we're losing about 1% of GDP. I mean, that's huge. We could add 1% of GDP just by expanding our securitization market, and that would also give flows into those, required investments there. The problem is, I think they're starting to work on it. I understand there is a lot of work that has been going on, and we're hoping to hear every more. That paper's now over 2.5 years old. And I think that is going to be absolutely essential, that Europe needs to actually come together and work out. I've had my own crazy ideas, but I will only share them over a glass of wine, because I'm not sure if they actually stand up to reality. But yeah, I think we definitely want to have building out that securitization market in Europe, having some consistency there. I mean, at the same time, yeah.
Does it have to be securitized though, or could it just be an expansion of the loan market? If it's kind of the same thing, if it's still corporate debt, does it matter if it's public or it's private?
Well, the securitization aspect, so that you've got the ABS, you've got all those other instruments there, that, that the fact that, Fannie, Freddie and Ginny have been around for a very long time, and yet we have no mortgage securitization. And I think we've all been looking at the States in the last few years thinking, gosh, why didn't we have a 20-year mortgage? And the answer is because they haven't been able to securitize it away. With that, personally, I think that would be a very great thing to have. But yeah, so not everything. So corporate wise, I think you're right, that could grow. But there's those other areas of securitization. So like looking at that ABS, like looking at credit card receivables, looking at all those other aspects that people want to invest, and actually there's a limitation at the moment. So if you build that out, it's a kind of a build it and they will come scenario, that if we build out that securitization market, it would enable more growth projects to be done. And I think there was another FT article, but some months ago, and it was reasonably depressing. It was sort of saying that I think they tried to get they tried to do some building of it. Wasn't an AI thing, but it was a similar, like, building out a project. And in Europe, and like, they'd managed 3 so far in the year, and at the same time in the States they'd done 300, sort of thing. Mm. So it really does actually hinder our growth. So by growing out the securitization market, you're going to free up, loosen those conditions, get some more borrowing, get some more lending going on. You can't have one without the other, obviously. So that could only be a good thing. I think certainly the other aspect, which is quite interesting there, that does worry me, is that basically that whilst I love those AAA CLOs, is as more people go into there, that beautiful complexity premium that I really enjoy might start to diminish slightly. So that's the fact that, so whilst you want more people to get into securitizations, the downside is the more people who understand them, the less people like me who can benefit from the fact that people don't understand them as well, and I can actually be paid more for doing so.
I mean, in life, it is rare to be able to spot a trend. It is even rarer to be able to spot a trend that is going to last for multiple decades, right? What retailer wouldn't give their entire body in order to know what people are going to buy for the next 20 years? And given that we've got these two massive trends, we've got insurers absorbing DB money, and you've got DC growing and growing and growing, also wanting corporate debt as well. I mean, you've got the demand, you just have to create the supply, right? It's crazy. Life just never gives you such an easy demand prediction like that. That is a trend that you can get on for the next 20, 30 years.
Which is what makes it so frustrating that it hasn't happened yet. And it's sort of like, and if you speak to everyone in the room agrees with you. Everyone's like, yeah, no, it's a fantastic idea. And you're like, so we're doing it? And they were like, oh, no, sorry, we haven't quite, worked out how that's going to work between Germany or France or et cetera, et cetera. You're like, surely just put everyone in a room. Like, maybe we should just do that, lock them all in a room. Can't get out until you just agree. Come on, guys.
Yeah. Sounds good. I think that now that we've solved all of the world's problems, and we've got our pub quiz name, Charlotte Squared. I think that's a great point for us to end the podcast. Thank you, Charlotte, so much for sharing your news story of the week and all those fascinating insights into how you think about fixed income and how you manage it for People Pensions members. Listeners, if you want to make sure that you never miss a future episode of the Professional Investment Podcast, make sure you hit that subscribe button. And thank you so much for listening.